Now, as we've been discussing, the annualised inflation figure out today at 6.1% is the highest for 2 decades, really for 3 decades when you put aside a blip in 2000 when the GST came in. None of us need reminding about this. We feel it every day at the petrol bowser, in the supermarket, or when we get our power bills. But not only did Labor promise they would lower our power costs, they also promised before the election that Labor was the party to increase wages. They were going to deliver real wage increases, that is, wage increases that are higher than inflation. And that is not a promise they're going to keep.
Clearly, when we've got inflation already north of 6%, we expect it to get higher, and I'll detail that tomorrow too. The idea that we would be forecasting wages growth that keeps up with that, I think would not be credible.
Yeah, economic reality is catching up with Labor fast, and it's clear they're not going to be able to deliver much of what they promised at all. What a mess. But let's delve into the economy and the real world, and for that I'm joined by Gareth from the Commonwealth Bank. Thanks for joining us again, Gareth. First up there, we heard the Treasurer, Jim Chalmers, saying that inflation is going to get worse before it gets better. How high will inflation go?
Well, on our estimates, it'll get up to close to around 7% through the year, but it's probably worth saying that the quarterly rates will probably ease a little bit from here. We're in this kind of unusual place at the moment where the annual rate is lifting, but if you look at the quarterly change today, the increase over the quarter of 1.8% was a little bit less than what we saw in the March quarter, which was an increase of 2.1%. So I think what we're going to see over the next couple of quarters is that annual rate continues to lift, simply because of lower numbers dropping out from last year in the annual calculation. But that quarterly pace of change should ease up a little bit, largely because the Reserve Bank is putting through rate hikes. That will act to slow demand growth in the economy, not immediately, but it will in the not too distant future. That in turn will start to reduce the pace at which prices are increasing. And then we should, as we go through next year, see that annual rate of inflation actually come down quite a bit.
But there are a couple of hits still to come, aren't there? The Treasurer pointed out that the July price hikes in electricity haven't gone into the inflation figures yet. And also, when the petrol excise discount comes off in a few weeks, petrol's going to jump up again, isn't it?
Oh, look, that's right. I mean, much of what happens on the petrol front will be dependent on where the oil price is, but there are definitely some things that are going to continue to rise in price, and the pace of those price rises will accelerate, particularly around utilities. But there will be some offsetting forces. Well, what we saw in the inflation numbers today were that fruit and veg prices jumped radically, in part because of floods on the east coast. Now, none of us can forecast the weather, but on the basis that we don't get a repeat of those floods, price hikes there will dissipate. The other thing too is that the cost of building a home in the past 12 months has increased by 20%, and that's worth about 7% of the CPI basket. So our expectation is that the price of building a new home just won't continue to ratchet up at the rate that it has, largely because as we move forward from here, we're actually going to be building less homes, given the impact that Home Builder had on accelerating the new building of homes. So there's going to be a lot of moving parts over coming quarters, and some of the things that households just hate spending money on but have to spend money on, like utilities, will continue to grow in prices. But I think given the Reserve Bank is pushing through with pretty aggressive rate hikes that's going to slow demand for certain things that we spend money on, then price rises in those components will dissipate. And yes, the annual rate will continue to tick up, but I don't think we're in some sort of wage price spiral. And as we go through next year, we've got the view at the bank that the rate of inflation is going to start to ease.
So that's encouraging news. Do we expect then that we will see, though, an interest rate hike of 0.5% next week?
Yeah, look, that's what we're expecting, and it's encouraging news to the extent that the rate of inflation will come down. But I'd say it's not encouraging news for home or for those that have got a mortgage, and particularly on a floating rate mortgage, because the Reserve Bank will continue to raise interest rates, and that'll put obviously upward pressure, or it'll increase mortgage repayments for those people on a floating rate. We're of the view that the Reserve Bank will be raising the cash rate by 50 basis points at the board meeting next week. That's a consensus call now. That's expected across most of the analysts that forecast the Reserve Bank. we shouldn't lose sight of the fact that 50 basis point increases in the cash rate are not historically normal. They've tended to move in 25 basis point clips. So we're still expecting quite a sizable hike next week, probably another one in September as well. So whilst it'll be good news next year that inflation comes down, the way it actually comes down is slowing demand growth in the economy. And that means for those people on a mortgage, they're going to be faced with higher interest cost on debt.
Yeah, indeed. It's going to be a tough period for people with mortgages. I do seem to remember in the Keating years, though, interest rates going up a full percentage point at a time, 100 basis points. I'd have to double check that. But I seem to have horrible memories of my first mortgage going that way. Thanks for joining us, Gareth. I appreciate your insights.
No worries, Chris. Cheers.
Gareth Ed there, who's the head of Australian economics at the Commonwealth Bank of Australia.